Imagine earning money while you sleep. Not from luck, not from gambling, but from owning pieces of strong companies that pay you just to hold their stock. Sounds too good to be true, right? Well, that's exactly what dividend investing can do when you use the right strategies. But here's the catch. Most beginners do it wrong, leaving piles of cash on the table without realizing it. In this video, I'm going to show you the dividend investing strategies that actually work, the ones real investors use to grow wealth year after year. Number 1. What dividend investing really means. Let's start simple. Dividend investing means buying shares of companies that pay part of their profits back to shareholders, usually every few months. These payments are called dividends. Think of it like renting out your money. The company uses your money to run its business, and in return, it pays you rent in the form of dividends. For example, if you own 100 shares of a company that pays $1 per share annually, you earn $100 each year just for holding that stock. Many people reinvest those dividends to buy more shares, and that's where the magic of compounding begins. Number 2. The secret behind dividend yield. Dividend yield tells you how much a company pays in dividends compared to its stock price. It's like your interest rate for investing. For example, if a stock costs $100 and pays $5 in annual dividends, that's a 5% yield. But here's where beginners often make a mistake: chasing high yields. A company offering a 10 or 12% dividend might sound amazing, but it could be a trap. Sometimes, a yield is high because the company's stock price crashed due to financial trouble. Always remember, if a dividend looks too good to be true, it usually is. A better approach is to look for a balanced yield, typically between 2 to 5%, from companies that have a history of steady payments. Number 3. Dividend growth is the real wealth builder. A high yield today is nice, but a growing dividend is even better. Some companies increase their dividends every single year, through good times and bad. These are called dividend aristocrats. They've raised dividends for at least 25 consecutive years. Imagine investing in a company that paid $1 per share 10 years ago, but now pays $2 or $3 per share. That's not only extra income, but also higher returns on your original investment. Think of companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson. They've been increasing their dividends for decades. This consistency is a sign of strong management and reliable profits. Number 4. The power of reinvesting dividends. Here's where your money starts working for you, and then your money's money starts working too. Reinvesting dividends means using the cash payouts to buy more shares automatically. Over time, those extra shares generate their own dividends, and the cycle repeats. For example, let's say you invest $10,000 in a dividend stock with a 4% yield. That gives you $400 in dividends in the first year. If you reinvest it, next year you earn dividends on $10,400 instead of just $10,000. Year after year, that snowballs. In 20 years, the difference can be staggering, often doubling or tripling your total value compared to taking the cash out. Number 5. Choosing the right companies. Not every company paying dividends deserves your money. You want companies with stable earnings, strong cash flow, and a history of not cutting dividends during tough times. Here's a simple way to think about it. Imagine two companies. Company A pays a 6% dividend but is struggling financially. Company B pays 3% but has grown consistently for 10 years. The smarter move? Company B. Because sustainability beats short-term temptation. Look for businesses in reliable industries: utilities, consumer goods, healthcare, and large banks. These sectors often generate steady income even during recessions. Number 6. The dividend payout ratio. A company can't pay dividends forever if it's paying out too much of its profit. The dividend payout ratio tells you how much of its earnings go toward dividends. If it's paying 80 or 90% of earnings, there's little room to grow or handle bad years. A healthy payout ratio is usually below 60%. It means the company still has enough money left to reinvest, grow, and keep paying you comfortably. For example, Apple's payout ratio is much lower than many traditional dividend stocks, but it still grows dividends each year because it has massive profits and cash reserves. Number 7. Dividend reinvestment plans, DRIPs. A dividend reinvestment plan, or DRIP, lets you automatically reinvest dividends into more shares without paying commission. Many companies offer this directly or through your brokerage. It's like setting your investment on autopilot. You don't need to time the market or worry about spending the dividends. The drip takes care of it for you. Over decades, this small automation can make you thousands of dollars richer. Number 8. Diversifying your dividend portfolio. Even the best companies can face problems, so never put all your money into one or two stocks. Spread your investments across different industries, like energy, healthcare, consumer goods, and finance. You can also invest in exchange-traded funds, ETFs, that focus on dividend-paying companies. For example, the Vanguard Dividend Appreciation ETF includes top-quality dividend growers. It's an easy way to get broad exposure and lower your risk. Think of diversification as your financial safety net. If one company cuts its dividend, others will keep your income steady. Number 9. Taxes and dividend income. Here's something many beginners forget. Dividends are taxable income. But not all dividends are taxed the same way. Qualified dividends, from most USA companies, are taxed at lower rates than regular income. For example, if you're in a 22% income tax bracket, you might pay only 15% on qualified dividends. Non-qualified dividends, like those from certain foreign companies or real estate trusts, are taxed higher. If you invest using tax-advantaged accounts like a Roth IRA, your dividend income can grow completely tax-free. That's one of the smartest ways to keep more of your money. Number 10. When to sell dividend stocks. Dividend investing is usually for the long term, but sometimes selling makes sense. For example, if a company cuts its dividend or its fundamentals weaken, that's a warning sign. Another reason could be when your goals change. Maybe you need to rebalance your portfolio or use the money elsewhere. But don't panic sell during normal market drops. Dividends keep coming even when stock prices dip. Many investors see downturns as opportunities to buy more shares at lower prices, boosting future income. Number 11. Avoiding common dividend mistakes. New investors often fall for a few traps. Chasing high yields, ignoring company health, and failing to diversify are big ones. Another mistake is not reinvesting dividends, which slows growth dramatically. And one more, not having patience. Dividend investing is a slow cooker strategy, not a microwave. You won't double your money overnight, but you can build serious wealth over time if you stay consistent. Remember, Warren Buffett made a big part of his fortune through dividend-paying companies like Coca-Cola and American Express. That's not luck. That's patience, reinvestment, and discipline. Number 12. Building your dividend snowball. Think of dividend investing like rolling a snowball down a hill. It starts small, but as it rolls, it gathers more snow and gets bigger and faster. Every reinvested dividend adds more to your snowball, creating more income, which buys more shares, which creates even more income. If you invest $500 a month into solid dividend stocks and reinvest every dividend, you could potentially earn thousands of dollars in annual passive income after a couple of decades. It's not magic. It's math and consistency. Number 13. How to get started today. You don't need thousands of dollars to start dividend investing. Begin small, with just one or two high-quality companies or a dividend-focused ETF. Open a brokerage account, enable dividend reinvestment, and stick to your plan. You can even use fractional shares to invest small amounts in expensive companies. For example, you could buy a fraction of a share of a company like Microsoft or Johnson & Johnson. The key is to start, not to wait for the perfect time, because the best time to start building wealth was yesterday. The second best time is today. Number 14. Focus on dividend stability. Before you buy any dividend stock, look at its payment history. A stable dividend means the company has consistently paid its shareholders through both good and bad times. For example, during economic downturns like 2020, some companies cut their dividends, but firms like Johnson & Johnson and Procter & Gamble kept paying. That reliability makes them attractive for long-term investors. A company that keeps paying even during recessions shows financial strength and solid management. Number 15. Understand dividend dates. Many beginners miss out on dividends because they do not understand how dividend dates work. There are 4 key dates: declaration date, ex-dividend date, record date, and payment date. You must own the stock before the ex-dividend date to receive the upcoming payment. If you buy after that date, you'll have to wait for the next one. Knowing these dates ensures you never miss your rightful earnings. For example, if a company's ex-dividend date is August 10th, you should buy no later than August 9th to receive the dividend. Number 16. Focus on total return, not just dividends. It's easy to get obsessed with how much dividend income you're earning, but total return, which includes both dividend income and stock price growth, tells the full story. A company with a smaller dividend but strong growth potential could outperform a high-yield stock with no growth. For example, a 3% yield plus 7% price appreciation is better than an 8% yield with a falling stock price. Smart dividend investors balance both income and growth for the best long-term outcome. Number 17. Consider dividend ETFs for easy diversification. If picking individual stocks feels overwhelming, dividend-focused exchange-traded funds, ETFs, are a beginner-friendly option. They hold dozens or even hundreds of dividend-paying companies, giving you instant diversification. Popular options include the Vanguard High Dividend Yield ETF and the Schwab US Dividend Equity ETF. These funds automatically adjust their holdings over time, making them ideal for people who prefer a hands-off investing style. You earn dividends regularly and spread your risk across multiple companies. Number 18. Keep an eye on dividend coverage ratio. This ratio compares a company's earnings to the amount it pays in dividends. A higher coverage ratio means the dividend is safer and more sustainable. If a company's coverage ratio falls below 1, that means it's paying more than it earns, a major red flag. For example, if a company earns $5 per share but pays $4 in dividends, the coverage ratio is 1.25, quite healthy. Anything below 1.0 suggests trouble ahead. Number 19. Dividend investing in different sectors. Every sector behaves differently when it comes to dividends. Utility companies and consumer staples often provide reliable dividends. Technology companies, on the other hand, may pay lower dividends but offer faster growth. Building a mix between defensive sectors like healthcare and growth-oriented ones like tech can help balance your portfolio. This approach helps protect your income even if one sector struggles. Number 20. International dividend stocks. You don't have to limit yourself to USA companies. Some international firms offer strong dividends and global diversification. For example, Unilever, Nestle, and Royal Bank of Canada have long histories of stable dividend payments. However, international dividends may be subject to foreign taxes or currency fluctuations, so always check those details before investing. Adding international exposure helps you spread risk beyond one economy. Number 21. Rebalancing your dividend portfolio. As time goes by, some stocks in your portfolio might grow faster than others, changing your balance. Rebalancing means adjusting your holdings to keep your portfolio aligned with your goals. You might sell some shares of an overperforming company and buy more of another to maintain balance. Doing this once or twice a year ensures you don't become overexposed to one stock or sector. It also keeps your risk level consistent while helping you lock in profits. Number 22. Using dividend income for financial goals. Dividend investing isn't just about building wealth. It's also about creating freedom. You can use your dividend income to pay bills, fund vacations, or reinvest for faster growth. Some retirees live entirely off dividends, treating them like a paycheck. Even if you're not retired, reinvesting dividends in your 20s or 30s can help you build a large passive income stream by the time you reach your 50s. Dividends give you flexibility. You decide how to use them. Number 23. Emotional discipline in dividend investing. The stock market can be emotional. Prices rise and fall, and it's tempting to panic sell when the market dips. But true dividend investors focus on income, not price swings. As long as the company's fundamentals remain strong and dividends keep flowing, there's no reason to worry. Remember, volatility is temporary, but dividend payments keep coming as long as the company is healthy. Patience is your greatest weapon in dividend investing. Number 24. Tracking your dividend income. It's motivating to see your passive income grow over time. Use a spreadsheet or a free dividend tracker app to monitor payments, yields, and annual growth. Seeing the numbers go up gives you confidence to keep going. especially during market dips. It also helps you identify which companies are growing their dividends faster than others. When you treat your portfolio like a business, you make smarter financial decisions. Every investor dreams of financial freedom, that moment when your money earns enough to cover your expenses. Dividend investing is one of the simplest, most reliable paths to get there. It's not about luck or timing. It's about owning quality companies, reinvesting consistently, and letting time do the heavy lifting. Now, imagine this. 10 years from now, your investments could be paying you steady income every month, enough to cover your bills, maybe even your vacations. Wouldn't that feel incredible? What about you? If you started earning dividend income today, what's the first thing you'd want it to pay for?